Hello, everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are generally up today, slightly. Nasdaq is up 0.4%, S&P 500 up 0.2%, Russell 2000 is flat. You can see the GDP second estimate came in slightly better than expected. Initial claims lower than expected. Continuing claims also flat. Pending home sales lower than expected. We're going to talk about that in a little bit. Crude oil at $64 per barrel, down slightly today. And the yield curve is down a couple basis points. If you look at the heat map, NVIDIA announced results. We're going to talk about that, down 1%. Tesla is down 2%. Google is up 2%. Healthcare is down generally. Financials are up generally. And everything else is mixed. Let's read the daily article of the day. NASDAQ drifts higher. NVIDIA outlook faces China overhang. The tech-heavy Nasdaq edged higher in choppy trade on Thursday, held back by a fall in Nvidia shares as Sino U.S. trade uncertainties prompted the AI chip giant to exclude potential China sales from its quarterly forecast. The exclusion came despite the company having secured certain licenses earlier this month to sell its H20 chips to major market China after reaching a revenue-sharing deal with the United States government. Nvidia shares were last down 1.3% in volatile trade as some analysts also raised concerns about whether the company's data center results hinted at tighter spending by cloud providers. I mean, we already know that is the case, so that's not a surprise. Still, Nvidia's strong quarterly revenue forecasts, $60 billion share buyback plan, and CEO Jensen Huang's upbeat comments placated investor concerns around artificial intelligence demand. Quote, China is a big part of their business, and until that's resolved, there's going to be a bit of an overhang on what they can do in terms of guidance and what they can project in terms of growth, said Thomas Hayes, chairman and Great Hill Capital. The enthusiasm around AI was the driving force behind Wall Street's nearly 3-year bull market run. The rally has survived multiple hiccups this year, including the unveiling of cheaper Chinese AI models and the US tariff-induced sell-off in April. Semiconductor peers Supermicro fell 1.1%, while Broadcom rose 2.5%, helped by brokerage Oppenheimer's price target raise. Major customers of NVIDIA, including Meta and Microsoft, were marginally higher. The broader S&P 500 technology sector gained 0.2%, and the chip index rose 0.3%. Data analytics company Snowflake gained 17.8% after raising its forecast for fiscal 2026 product revenue, citing AI demand. HP rose 2.4% after beating quarterly revenue estimates on growing demand for AI-powered personal computers. The other dominant theme behind the benchmark S&P 500's rise to record highs has been expectations that the Federal Reserve could lower interest rates for the first time this year in September. Traders are pricing in an 88.8% chance of a rate cut next month, according to data compiled by LSEG. Placating worries of slowing economy, weekly jobless claims were lower than expected, while separate reports showed corporate profits rebounded in the second quarter. The spotlight is now Friday's personal consumption expenditures data, and any signs of inflation increasing could temper expectations for a September rate cut. Also on Thursday, Fed Governor Lisa Cook filed a lawsuit challenging U.S. President Donald Trump's attempt to remove her from office earlier this week. Coming later in the day are remarks from Fed Governor Christopher Waller, who is perceived as dovish and among the candidates being considered to replace Fed Chair Jerome Powell next year. Among others, packaging food company Hormel Foods lost 13.5% after issuing a downbeat quarterly profit forecast. Let's look into the Fed news a bit more. The Fed's Lisa Cook sues Trump and the Fed in an effort to keep her job. Lisa Cook, a governor on the Federal Reserve Board, sued President Trump, the Board of Governors of the Federal Reserve System, and Fed Chair Jerome Powell on Thursday, alleging that the president's move to fire her violated her executive authority and illegally deprived her of her due process right to respond to accusations that she committed mortgage fraud. The high-stakes case posed as test for how much influence a U.S. president can exert over the nation's monetary policy. Cook, 61, asked the District of Columbia's Federal District Court for an injunction immediately, confirming her status as an active member of the Board of Governors, and to make a series of declarations to safeguard her and the board's congressionally mandated independence. The president's actions violate Governor Cook's Fifth Amendment due process rights and her statutory right to notice and a hearing under the Federal Reserve Act, the six-count complaint stated. The lawsuit's actions against the board and Chair Powell, it said, were limited to the extent that any individual Fed governor is able to effectuate the president's attempted termination. Cook has refused to resign from her post in the wake of a termination letter signed by the president that was made public on Monday. Trump's letter asserts his authority to fire the Fed governor for cause based on the White House allegations of mortgage misconduct. Cook responded on Monday saying that the for cause justification for her termination did not exist. I will not resign, she said. I will continue to carry out my duties to help the American economy as I've been doing since 2022. More on Trump. Trump tariffs are increasingly forcing countries to pick sides between the US and China. President Trump's trade wars are increasingly forcing countries to choose between the US and its main adversaries, China and Russia. It's a theme that has been evident for months but has been on heightened display this week, with headlines from India to Mexico underscoring that nations are not necessarily destined to choose the US. On one side is India, which is now facing 50% US tariffs on an array of goods. Those duties are set to be felt in everything from textiles to solar panels, in part due to the country's continued purchases of Russian oil. But the US pressure campaign to stop those purchases has, for now at least, clearly pushed India towards US adversaries. Not only do India's imports of Russian oil appear to set to continue, they're even likely to rise in September, according to a Reuters report. An Indian prime minister is preparing for a high-profile visit to China later this week, in what will be Modi's first visit to China in 7 years. On the other side of the spectrum this week is Mexico. America's southern neighbor is eyeing new tariffs on China that could distance it from Asia. It's a possible move that would deepen ties to the U.S. ahead of high-stakes negotiations coming next year on renewing the United States, Mexico, Canada agreement, USMCA. Bloomberg News reporting that the Mexican government plans to formally unveil these new China tariffs next month and could focus on imports such as cars, textiles, and plastics as part of a 2026 budget proposal. Notably, the report added, the tariff increases may also target other Asian countries. As Capital Economics added in an analysis, it's evidence of a top Trump priority in getting Mexico's help to keep China out of U.S. supply chains. It's also evidence, the report added, of how America's southern neighbor appeared particularly susceptible to U.S. pressure to put tariffs on China, given its independence on U.S. final demand. But India appears headed in the opposite direction. Syracuse University professor of economics said this week that India's ties with China could deepen in the months ahead and perhaps even open the possibility that it joins a China-led Asian free trade agreement. Mitra noted that with the climate President Trump has created, it won't be surprising if both India and China find this a mutually beneficial transaction. On Fox Business earlier this week, Treasury Secretary Scott Bessent said that the Indian team began negotiations early and that he thought India could be one of the earlier deals, but they kind of tapped us along in terms of the negotiations. Interesting. All right. Switching to Tesla. Tesla's Europe sales crater 40% in July as BYD competitors gain. Tesla's troubles in Europe are worsening. Per the European Automobile Manufacturers Association, Tesla EV registrations, a proxy for sales, in Europe fell to just 8,837 units in July, a 40.2% drop compared to a year ago. Meanwhile, the total EV registrations in the region, which includes the UK and the European Free Trade Association, rose 33.6% in July, with overall registrations, regardless of powertrain, up 5.9%. July's total marks the seventh straight month of declining Tesla sales in the European region. July's total was worse than the drop seen in June, when sales dropped 22.9% year over year to 34,781 units. The stock was down 2% in midday trade. Tesla's sales hangover rolled on in certain key territories in Europe, as the introduction of the revamped Model Y was not enough to blunt the effect of rising competition and CEO Elon Musk's deep unpopularity. Registration data, a proxy for sales, was lower for key regions. France down 27%, Netherlands down 62%, Denmark down 52%, and Sweden down 86%. In particular, France and the Nordic countries are major sales territories for Tesla. The sales as it comes from national auto sources and was first reported by Reuters. But July's weakness overall comes on the back of a rough 2025 thus far. In the first half of the year, Tesla sales dropped 33% to just 110,000 units, again per the ACEA. Musk warned after Q2 earnings that Tesla was in for a few rough quarters as the company delayed the launch of its cheaper EVs until the federal EV tax credits expired in the US. But Musk's warning doesn't mention his reputational hit stemming from his political involvement in the Trump administration. The rise of more competition and consumer preferences for vehicles like hybrids that have Tesla and the EV industry as a whole worried. In terms of competition, China's BYD, which sells both full EVs and hybrids, saw registrations surge 225% in July to 13,503, easily topping Tesla. Volkswagen Group, which has seen its EVs embraced in Europe to Tesla's detriment, saw registrations jump 11.6% in Europe. BYD notched an 11.6% gain, with its mini brand popping 41%. For Tesla in particular, weakness in key regions such as Europe has been an ongoing issue. The company also saw sales dip in China, down 8.4% from a year ago. Sales in the US could be a bright spot for the company. Tesla does not report monthly sales, but reports suggest US wait times for Tesla EVs, such as the Model Y, are growing, with the theory being buyers are pulling forward EV sales ahead of the expiration of the $7,500 EV tax credit on September 30th. More on Tesla. How Tesla and Waymo's radically different robotaxi approaches will shape the industry. A month after Tesla launched a trial robotaxi service in Austin, Texas, in June for select fans, CEO Elon Musk told investors that the company's driverless taxis will likely be available to half the population of the US by the end of this year. Alphabet's I can Alphabet's Waymo, the US leader in autonomous ride hailing, launched a similar test service in Phoenix more than 8 years ago. Today, it operates in areas with about 3% of the US population. Musk's pronouncements about expanding Tesla's robotaxi at a hyper-exponential rate stand in contrast to Waymo's deliberate approach ahead of entering new markets. Musk sees a faster path to scaling the business because of Tesla's reliance on just cameras and AI, compared to Waymo's rules-based approach that uses more sensors and high-definition mapping. The differing strategies have far-reaching implications for the early pecking order in the nascent autonomous driving space, which some analysts and investors say could become a multi-trillion-dollar market over the next 15 years. Waymo's expansion playbook involves comprehensively mapping new cities and phasing in autonomous ride-hailing after testing technology with drivers in the front seat and employees as passengers. Tesla says its robotaxis use a different autonomous technology from Waymo's, one that allows it to bypass much of that painstaking prep work. The cars, still in the testing phase, use AI that reacts to road conditions the way a human would. Tesla says that requires less extensive road testing and mapping. Once we can make it basically work in a few cities in America, we can make it work anywhere in America, Musk told analysts on a conference call in April. He has called Waymo's approach fragile, saying its ability to expand is limited. Many investors have bought into Musk's vision. Some analysts attribute the vast majority of Tesla's stock market value to autonomous driving capabilities that investors are betting can reach scale much faster than Waymo's efforts. If successful in a rapid commercial expansion, the robotaxi business could solidify a new growth engine for Tesla. Reuters interviewed a dozen current and former industry executives, regulators, law enforcement officials, and city planners to contrast Tesla's early expansion efforts with those of Waymo, revealing sharp contrasts in their technical and go-to-market strategies. Current and former Waymo executives say their market-by-market approach of mapping and testing before expansion is essential to ensuring safety, helping factor the peculiarities of each city's roads, for example, steep inclines in San Francisco that make it difficult to see what's ahead. We really need to understand the core ingredients of each of these cities, said Aman Nalavade, a Waymo product manager, in an interview with Reuters. There is a lot of risk in doing this incorrectly. Musk has also talked about the importance of safety. We don't want to take any chances, so we're going to go cautiously, he said last month. Tesla did not respond to requests for comments. Contrasting tech. Tesla and Waymo both use AI in autonomous driving, but Waymo's technology involves more of a step by step process where its system takes in data from high definition maps and advanced sensors to recognize objects and plan the vehicle's path. Tesla, by contrast, says its system makes driving decisions more like a human. The company has said it uses an AI method where video captured by the vehicle's cameras is interpreted by software and instantly translated into driving decisions without the intermediate steps used by Waymo. Waymo has experimented with aspects of Tesla's approach, but said in a research paper last year that there are challenges and limitations with its performance. Musk has set an ambitious timeline of having millions of Teslas operating autonomously by the second half of next year. Well, it was 1 million in 2022, which didn't happen. And I don't think it's going to happen either, which compares Waymo's roughly 2,000 vehicle fleet currently. After launching the pilot program in Texas in June, Tesla is awaiting approval in Arizona and looking to expand to states including Nevada and Florida. The pressure is on for Tesla to deliver on these promises because its core electric vehicle business faces headwinds. Its vehicle sales have declined globally, including sharp drop in Europe. Falling behind Musk's robotaxi timeline would delay a key new revenue stream. Waymo is the only company in the US offering a paid, fully autonomous ride-hailing service open to anyone. It operates in the San Francisco Bay Area along with parts of Los Angeles, Phoenix, Austin, and Atlanta. Before expanding into a new market, Waymo fine-tunes its technology through testing its virtual simulators on a closed 113-acre California course and on city streets where it plans to launch. In Phoenix, it started offering test rides with a driver in the front seat more than 3 years before opening a paid driverless ride-hailing to the general public in 2020. It took nearly 4 years until Waymo opened up autonomous service and in time at Phoenix's airport terminals in August 2024. Waymo says it's reducing the testing time in new cities as its autonomous technology gains more experience and applies previous lessons to new geographies. Paul Miller, an analyst at market research firm Forrester, said Waymo's approach is safer and more realistic in the short term, while Tesla's approach is a riskier bet but a far cheaper approach to scale globally. Bank of America analysts estimate Waymo lost between 1.2 billion and 1.5 billion last year, but analysts expect the Waymo's model will eventually be profitable as vehicle costs come down and ridership grows. Morningstar analysts projected in a March report that Waymo would have a rapid ramp-up period over the next few years, while Tesla will have a slower initial robotaxi rollout because its software will not be ready. I agree with that view. Morningstar expects Tesla to launch fully autonomous robotaxis by 2028. No way. And surpass Waymo's ride-hailing market share by the end of the decade. That's not going to happen. Even with Waymo's meticulous approach to studying new markets, it has encountered problems and rankled some city officials. In Austin, where it started offering autonomous rides through the Uber app in March, authorities have often seen Waymo vehicles ignore officers' hand signals and drive into dangerous situations, said Austin Police Lieutenant William White. In May, a Waymo vehicle drove into floodwaters and the passenger had to find a way out. Obviously, that's a huge concern to us, said White. If that person had died, we could have been looking at a serious criminal incident. Last year, during a charity walk near downtown Austin, a Waymo vehicle tried repeatedly go around an officer who was clearly blocking a roadway. Police eventually disabled the vehicle by wrapping tape around one of its sensors, White said. Austin police have had to create a new system of traffic citations to handle repeated instances where Waymo vehicles froze and blocked traffic, White said. Police have issued 3 citations to Waymo since March. Officers have said the process for citing a driverless vehicle is so time-consuming that they often avoid it. If they decide to pursue it every time, we will be talking about hundreds of citations by now, White said. The department has had limited interactions with Tesla's robotaxi service so far because it is just getting started. Waymo spokesperson Chris Bonelli said the company has had robust engagement with Austin police, that's one way of putting it, and fire officials for more than 2 years. Waymo takes all observations and concerns seriously and uses that feedback to improve the performance of our technology, he said. Beyond the technical challenges, autonomous vehicle firms must navigate a patchwork of regulations while also reassuring community leaders who might be apprehensive about driverless vehicles. For example, Waymo started meeting with local officials more than a year before its March launch and attended city organized meetings with representatives of the Texas School for the Deaf, among other local organizations. School representatives took demo rides in Waymo vehicles ahead of the launch. School Superintendent Peter Bailey said he briefly met representatives from Tesla a few months before Tesla's June launch and learned about the timing from news reports. The day of the launch, a Reuters reporter observed a Tesla robotaxi speeding between 40 and 45 miles an hour in a 35 miles per hour zone near the school, where a sign warned drivers to watch for deaf pedestrians. This is unbelievable. Bailey declined to comment on Waymo and Tesla's approaches to community outreach. He said he expects all drivers, including autonomous vehicles, to follow posted speed limits and operate with caution around school zones. Differing regulations around the country can also bog down expansion plans, Waymo's experience shows. The company targeted a 2026 launch in Washington, D.C., for example, but it's not clear the city will pass the needed regulations in time. The DC Council has been waiting years for a report from the city's transportation department on recommendations for commercial driverless vehicle rules before moving ahead. While the regulations may be ready by the end of 2026, there is no timeline for passage, said Council member Charles Allen. Waymo has hired 3 outside lobbying firms and is circulating online petitions urging residents to help bring Waymo to DC. DC's Department of Transportation said Tesla has not reached out. And that's the end of the article. That's a pretty good article. I wrote this article by Chris Kirkham. All right, moving on to other automotive news. Volkswagen extends Amazon Cloud partnership to save costs with AI. Volkswagen has extended its factory cloud partnership with Amazon Web Services by another 5 years, the German car maker said on Thursday, as it rolls out the use of AI to improve production and reduce costs. The company partnered with the cloud computing services unit of Amazon.com to create a digital production platform, or DPP, which Volkswagen says is already used in 43 locations in Europe, North America, and South America. Globally, Volkswagen has over 114 production sites. Our ambition is to become a global technology driver for the automotive industry. To this end, we're consistently digitizing and networking our company in all areas, Volkswagen's chief executive for IT said in a statement. Volkswagen factories connected to the cloud platform can operate more efficiently, for example, by optimizing the interaction of complex processes in vehicle assembly, the statement said. The company, which is undergoing a major overhaul to cut costs, estimates group-wide savings in the tens of millions of euros as a result of these systems in the medium term. And one more news from automotive industry. Chinese car makers resist Beijing's call to end brutal price war. China's campaign to stamp out a ferocious EV price war seems to be having a limited effect, with all of the nation's top 20 auto brands either keeping discounts intact, deepening them, or only slightly reducing them in July. With car makers still grappling with overcapacity and lackluster consumer sentiment, 7 brands offered bigger discounts despite Beijing's plea in June to avoid rat race competition, data from China Auto Market show. The others either reduced their discounts a little bit or kept them unchanged. The level of promotions last month was higher than a year earlier also. I think Tesla China has peaked already and it's just going down from here. Year-to-date sales are down, and I think the pace of declines are going to accelerate. All right, switching to NVIDIA. NVIDIA analysts look past tepid outlook, lift price targets. Analysts are staying bullish on NVIDIA, boosting price targets, even as the world's most valuable company offered a forecast that underwhelmed investors. Citing the chip giant's longer-term prospects, at least 10 firms hiked their 12-month price targets after its results Wednesday, raising the average by 3% to $202.60, according to data compiled by Bloomberg. That implies a gain of about 12% from Wednesday's close. JP Morgan analysts, led by Harlan Sur, cited a ramp-up in the firm's Blackwell AI chips. We believe NVIDIA's 12-month forward order book continues to outstrip supply, he noted, reinstating his overweight rating on the stock and lifting his price target 26% to $115. NVIDIA gave a tepid revenue forecast for the current period, projecting sales would be roughly $54 billion in the fiscal third quarter. Though that was in line with the average Wall Street estimate, some analysts had projected more than $60 billion. While noting sales results and guidance were both slightly below buy-side expectations, Truist Securities analyst William Stein raised his target by 9% to $228. Quote, We recognize this is a minor imperfection and instead focus on management's resilient longer-term outlook, end quote, he said. Shares in Nvidia briefly erased earlier pre-market losses to turn positive after Jensen Huang spoke with Fox News about selling Blackwell AI chips to China and giving the US a cut of those sales. Wall Street remains overwhelmingly bullish on the stock, with 72 buy equivalent ratings. Only 7 analysts have a hold rating, and the stock has a sole sell rating, according to data compiled by Bloomberg. Shares in the Santa Clara, California-based company had rallied about 35% since it reported first quarter results in May, adding more than $1 trillion to its market capitalization in the period. While expectations were high coming into the earnings, most important boxes were checked, Morgan Stanley analysts wrote. Still, there's also little clarity when it comes to China. Though the Trump administration recently eased curbs on exports of some AI chips to that country, the reprieve hasn't yet translated to a rebound in revenue. China remains impossible to forecast, and the management seem cautious about prospects to resolve the issues. The analyst who raised his target from 210 to 210 from 206 said. All right. Now let's switch to macroeconomics. Zachary, thank you very much for reposting the stream. That helps increase the visibility. Thank you, Zachary. All right. More macro/micro news. Dix falls as Wall Street frets over execution on Foot Locker. Dick's Sporting Goods shares fell as the retailer prepares to acquire Foot Locker, a sign that investors are nervous about the management's ability to turn around the struggling sneaker chain. The retailer raised its outlook, but not enough to satisfy Wall Street ahead of the transaction. Dick's now sees comparable sales growth in the range of 2% to 3.5% for the full year, and earnings per share at $13.90 to $14.50, above its previous projections. The forecast includes expected impact from all tariffs currently in effect. The conservative guidance paints a weak demand picture for the second half, even though Dick's customer appears strong with growth across categories and income levels, said Lindsay Dutch, an analyst at Bloomberg Intelligence. There may also be concern about Foot Locker and executing on the turnaround there. Dick's shares dropped 5.3% at 11:51 a.m. in New York on Thursday. The stock has fallen 1.2% this year through Wednesday's close, below the 10% gain for the S&P 500 index. The $2.4 billion Foot Locker deal is expected to close on September 8th. The agreement will unite two retailers with vastly different business models, with Dick's adding about 2,400 mostly mall-based stores to its network of around 800 big box sporting goods locations. Interesting. Dick's chief executive officer, Lauren Hobart, has yet to present a detailed strategic vision for Foot Locker, but Dick's has said it expects to operate the company as a separate business unit. Hobart said on a conference call with investors and analysts Thursday that management has become increasingly optimistic after spending time with Foot Locker executives, and Dick's will invest in its sneaker stores and marketing. Executives put off providing more details about their plans until the third quarter. In May, Dick's chairman Ed Stack addressed investor concerns about the acquisition, trying to assure them that Foot Locker will reach shoppers and that Dick's doesn't yet have access to, and that executives will improve operations at the ailing retailer. Hobart has been investing in Dick's store network, adding more experiential shops while improving e-commerce functions. The latest results show these efforts are paying off with shoppers. Comparable store sales rose 5% for the quarter ended August 2, surpassing the average analyst estimate. Interesting story. All right, now macro. Housing wealth in America is slipping. It's part of a larger trend. A nationwide index of housing prices showed that home values grew at a rate slower than inflation in June, which might indicate a cooling market. Housing prices are diverging by location, with prices in the Northeast and Midwest climbing, while prices in the South and West fell. Housing inventory levels are up, which is keeping prices down in some locations. Fresh data by U.S. home values is the latest sign that the market is dimming for sellers. The problem, growth rate of home prices isn't keeping up with inflation, which might indicate a cooling market. In some areas, prices are actually falling. At the same time, housing inventory is climbing, giving buyers more options to choose from than they've had in a while. Nationwide home prices in June were up 1.9% year over year, according to the most recent S&P Totality Case-Shiller Home Price Index. That's the slowest growth rate since the summer of 2023. Prices grew much more slowly than the 2.7% rate of inflation recorded in the same period, effectively putting the brakes on the pandemic era housing boom. For the first time in years, home prices are failing to keep pace with the broader inflation, said Nicholas Godek, head of fixed income tradables and commodities at S&P Dow Jones Indices. American housing wealth has actually declined in inflation adjusted terms over the past year, a notable erosion that reflects the market's new equilibrium. Reversing pandemic era trends. The shift comes after a years long run up in home values. The growth rate for home prices hit its peak of 20.7% year over year in March 2020. I don't know. The growth rate of home price hit its peak 20.7% year over year in March 2020. I don't think that's true. I'm going to check that later. The market's health is supported. No. The market's health is supported by a cumulative 49% home price appreciation for a typical American homeowner from pre-COVID July 2019 to July this year, said National Association of Realtors chief economist Lawrence Yun. Overall, homeowners are doing well financially. Still, data from July also indicates the market is softening. In July, existing home sales prices grew a meager 0.2% year over year, far less than the inflation rate. The average price of a new home in July fell by 5.9%. Wow. See, I haven't seen this one quoted before. Meanwhile, mortgage rates remain elevated at 6.7%, posing another challenge for buyers and sellers alike. Housing markets are local, so home values and sales trends depend on where you live. During the pandemic, home building boomed in regions like the South and West, but now an oversupply in these areas are driving price drops. Tampa home values fell by 2.4%, and San Francisco prices were down 2% year over year, the index showed. Another interesting article. Mortgage rates hit fresh 2025 lows despite Trump Fed drama. Let's read the summary on this one. If you have any questions, comments, you can leave it in the chat. I'll get back to it after the stream. Mortgage rates fell to a new year-to-date lows this week, with the average 30-year fixed-rate mortgage dropping to 6.56%. This decline follows Federal Reserve Chairman Jerome Powell's comments about potential rate cuts due to labor market concerns. Despite President Trump's criticism of the Fed and his efforts to exert control, financial markets remain largely unaffected, allowing mortgage rates to trend downward. And a final note on the housing market. The U.S. pending home sales fall more than expected in July. Contracts to buy previously owned U.S. homes fell more than expected in July as higher mortgage rates and a slowing labor market sidelined prospective home buyers. The NAR said on Thursday pending home sales based on signed contracts slipped 0.4% last month. Economists polled by Reuters had forecast contracts which become sales after a month or two dipping 0.1%. Pending home sales rose 0.7% from a year earlier. High mortgage rates have undercut the housing market, though the mortgage rates have eased from the year's lofty levels on expectations that the Fed would resume cutting rates in September. They remain elevated. A slowing labor market is also becoming a constraint for home sales. Even with the modest improvements in mortgage rates, housing affordability, and inventory, buyers still remain hesitant, said Lawrence Yun, the NAR's chief economist. And on that note, thank you very much, everybody, and I will chat with you all next time. Take care.